The market is sending warning signs, and it's getting harder to ignore. Stocks are swinging like a roller coaster. The Fed is stuck between a rock and a recession, and Trump just threw another wrench into global trade. But here's the real question. Is this just another market dip, or are we on the edge of something much bigger? Most people think stock crashes happen overnight. One day everything's fine, the next day, boom, meltdown. But that's not how real financial crises unfold. They start as whispers, turn into warning signs, and then, before you know it, they become headlines. Right now, we're in that warning phase. What if this isn't just another dip? What if we're witnessing the beginning of an economic reset? What if, instead of panicking, this is actually the greatest opportunity in years? This isn't about throwing out scary predictions. We're breaking down market and political events and expert insights to give you a clear picture of what's happening and what you should be doing next. Let's start with the biggest stories shaking up the market this week. Just when we thought trade tensions were cooling, Trump announced new tariffs on China, and Canada retaliated with energy export fees. Markets reacted instantly, with tech and manufacturing stocks taking the biggest hit. The Nasdaq dropped while the S&P 500 struggled to find footing. Meanwhile, Nvidia, Tesla, and Amazon showed some resilience. But is this a real rebound or just a dead cat bounce? Inflation data is cooling, but job numbers are messy. The Fed is stuck in the ultimate catch-22. Cut rates too soon, and inflation could spiral again. Wait too long, and they risk pushing the economy into recession. Companies like Broadcom and Marvel had mixed earnings. But here's the crazy part. Even companies that beat expectations saw little to no upside, while those that missed got destroyed. Now let's talk about what most investors are missing. Volatility is spiking. The VIX, Fear Index, is climbing fast, meaning investors are uneasy. Historically, when the VIX spikes this high, it often precedes major market downturns. But it also means opportunity for those who know where to look. Earnings no longer drive stocks. In a normal market, solid earnings lead to stock gains. But this season, companies exceeding expectations aren't rallying, while those missing earnings are seeing huge drops. This suggests that investors are no longer just looking at company fundamentals. They're pricing in macroeconomic risks beyond corporate performance. Recession risks are growing. Major banks like J.P. Morgan and Goldman Sachs just raised recession odds to 30 to 40% for the next 12 months. Analysts are citing the combination of slowing growth, Fed policy uncertainty, and geopolitical tensions as major factors pushing the economy toward a potential downturn. Bond yields and the inverted curve. The bond market has long been considered one of the best predictors of recessions. Right now, the yield curve is still inverted, meaning short-term bonds are yielding more than long-term ones. This has preceded every major recession in the past 50 years, and it hasn't been wrong yet. Institutional investors are selling. Hedge funds and large money managers are reducing risk exposure, pulling back from equities, and rotating into defensive assets. Historically, this kind of behavior signals that big players expect more downside ahead. Consumer spending is slowing. The latest economic reports show a decline in retail sales and consumer confidence. When consumers start tightening their wallets, corporate revenues take a hit, setting off a chain reaction in the markets. These signals don't necessarily mean a crash is imminent, but they do indicate that markets are moving from optimism to fear, a crucial psychological shift that can accelerate market declines or cause erratic price swings. Every market downturn has a trigger, a unique set of conditions that separate it from past crises. This time, the warning signs are different, and they point to a much more complicated problem. Let's break it down. In previous downturns, presidents have often stepped in to calm investors, push for market-friendly policies, and reassure the economy. But Trump doesn't play by those rules. He's openly willing to let markets suffer if it means achieving his broader goals, whether that's bringing manufacturing jobs back to the U.S. or renegotiating global trade deals. Just this week, he revived trade war tensions by announcing new tariffs, sending stocks into a tailspin. And when questioned about the market's sharp drop, he dismissed concerns, saying it wasn't a big deal. The Federal Reserve is supposed to be the market's safety net, cutting interest rates when things slow down. But this time, the Fed is completely trapped. If the Fed cuts rates too soon, inflation, which has been cooling down slightly, could come roaring back. Investors would get a temporary boost, but it could lead to long-term economic damage. If the Fed waits too long to cut rates, the economy could slow down too much, tipping us into a recession. Layoffs will increase, consumer spending will drop, and the market will take an even bigger hit. The problem? Powell has no easy way out. He's stuck between fighting inflation and preventing a recession, and whatever decision he makes will have massive consequences. Unlike past crises where the Fed could swoop in with rate cuts and stimulus, this time their hands are tied, and the market knows it. While most of the stock market is struggling, AI-related stocks are still holding up. Nvidia, Tesla, and other AI-driven companies have continued to show strength despite broader weakness. But here's the catch. The rest of the market isn't following. Is this a sign that only AI-driven sectors will thrive while everything else struggles? If so, we could see a massive divergence between tech leaders and the broader economy, creating a two-speed market where only a few sectors succeed while the rest decline. This could lead to further market volatility as investors scramble to position themselves in the right sectors. One of the worst-case scenarios for any economy is stagflation, a mix of slow economic growth and persistent inflation. The warning signs are already showing up. Growth is slowing, but inflation remains higher than ideal. Job numbers are getting weaker, but prices aren't falling fast enough to justify rate cuts. Consumer confidence is dropping, meaning spending is likely to decrease, further slowing the economy. Why stagflation is a nightmare? The Fed can't cut rates aggressively because inflation is still lurking in the background. The market doesn't have a clear path to recovery, making investors more anxious. Businesses struggle with high costs, leading to more layoffs and weaker earnings. The market is shifting in ways we haven't seen before. With Trump's unpredictable policies, a Fed stuck in limbo, and AI stocks separating from the rest of the economy, this crisis is playing by a whole new set of rules. So the question is, will you adapt to these new market realities, or will you get caught unprepared? Are you positioning your portfolio to survive this economic reset? Next, let's talk about how to protect yourself and even profit from the chaos. By now, we've covered the warning signs. We've broken down why this crisis is different and what's causing the turbulence. But the real question is, what should you actually do? Because surviving a financial storm isn't about doing nothing. It's about taking action before the worst hits. Let's talk strategy. First, let's address the most important shift in today's market, moving from speculative high-growth stocks to solid defensive plays. For years, tech and AI stocks have been the market's golden children, but when uncertainty rises, history tells us that companies with strong balance sheets and steady cash flow hold up better. Think about it. No matter how bad things get, people still pay their electricity bills. They still go to the doctor, they still buy groceries and basic goods. This is why utilities, healthcare, and consumer staples become the go-to sectors in times like these. Institutional investors, who control the bulk of market movements, know this, and that's where they start moving their money when things get shaky. If you're overexposed to riskier plays, it may be time to rotate into companies that generate consistent revenue and dividends, because when markets get rough, cash flow is king. But playing defense alone isn't enough. You need to hedge against volatility. And no, I'm not saying go all in on shorting the market or making panic trades. I'm talking about strategic positioning with assets that thrive when the market turns unstable. Gold has already gained over 10% this year, and for good reason. When confidence in the market drops, investors turn to hard assets that retain value. Bonds also play a role, especially long-term bonds, which could see strong rebounds if the Fed pivots. And if you want protection against an outright crash, inverse ETFs like SQQQ or SPXS can act as shock absorbers, moving up when the market moves down. The key is not to panic, but to have small hedges in place that can cushion the blow if things get worse. Now let's talk about tech. AI stocks are still strong, but here's the problem. Not all tech companies will survive this volatility. The ones with real earnings and dominant market positions will hold up, but speculative companies with weak fundamentals, they'll get crushed. If you're holding tech, you need to separate the hype from the reality. Companies like Nvidia, Microsoft, and Google are still positioned well, but many others that soared in 2021 purely on future potential are now struggling under the weight of rising interest rates and tighter liquidity. The best approach? Stick with leaders in the sector and avoid companies that can't back up their valuations with solid revenue and cash flow. But even with the right hedges and sector rotations, you need to have one of the most important things in investing: liquidity. Holding cash in times like these isn't about sitting on the sidelines. It's about having firepower ready when real opportunities arise. Every major downturn in history has led to massive buying opportunities, but the people who took advantage were the ones who had cash when everyone else was panicking. Think about it. During the 2008 crash, those who bought near the bottom made life-changing gains. In 2020, when the pandemic caused a massive market drop, the investors who bought during the fear made some of the biggest returns of the decade. The problem is most investors wait too long. They either panic and sell everything, or they sit on cash for too long, waiting for the perfect moment, which never comes. The best approach? Hold 20 to 30% in cash reserves and have a clear watch list of stocks you want to buy. That way, when the market drops, you're not scrambling. You're executing. Now, if you're thinking, okay, this all makes sense, but what should I actually do today? Here's your game plan. First, check your portfolio and ask yourself, are you overexposed to high-risk stocks? If the answer is yes, start rebalancing now. Second, hedge against volatility. That could mean shifting into defensive sectors, increasing your bond exposure, or even adding gold as a safeguard. Third, pay attention to key market signals, economic reports, inflation data, and especially the Fed's next move. The market is looking for certainty, and every major decision from here will dictate where things go next. And finally, don't just hold cash. Be strategic with it. Identify the stocks or sectors you'd buy if prices dropped another 10 to 20%, and be ready to strike when the time comes. At the end of the day, the biggest mistake investors make isn't that they panic. It's that they fail to prepare. If you wait until the market has already crashed to start thinking about defensive positioning, it's too late. If you wait until the recovery is obvious to start buying, you've already missed the best prices. The investors who win in the long run aren't the ones who predict every move. They're the ones who plan ahead, who adapt, and who position themselves before the chaos hits. At this point, you may be wondering, okay, how much should I bet? Right now, other investors are either betting too much and risking everything, or playing it too safe and missing out on opportunities. But what if there was a mathematical way to find the perfect balance? That's exactly what the Kelly criterion does, and it's the secret behind the smartest investors' success. If you want to learn how to bet big when the odds are in your favor, but never too big, watch my breakdown of Kelly's secret formula right here.